Papua New Guinea's Treasurer, Ian Lingstucky, has welcomed the recent announcement of a $1.4 billion budget support loan from Australia, stating that it is beneficial for the country. He emphasized that the loan carries an interest rate of 4.2%, which is significantly lower than the 8.4% rate of previous commercial loans acquired under former Prime Minister Peter O'Neill's administration, which also included high upfront fees. Lingstucky criticized the 2018 sovereign bond, describing it as a key factor in PNG's debt being classified as high risk instead of medium risk but sustainable. He pointed out that the entire $2 billion from the bond must be repaid in one lump sum by August 2028, which he considers a poor financial decision. In contrast, the Australian loan will be repaid gradually over 20 years. As part of the agreement, PNG is required to explore solutions, including working with the International Monetary Fund (IMF) to manage the 2018 bond repayment effectively. The Treasurer stated that as of December 31, 2024, PNG's debt levels were slightly lower than projected in the mid-year fiscal outlook, signaling an improvement in economic management. He highlighted the government's ongoing efforts to strengthen the economy, including a record period of non-resource sector growth since 2020. However, he acknowledged that many citizens remain worse off compared to 2012. To address economic challenges, the government has introduced household assistance programs and is implementing a 13-year budget repair plan aimed at achieving a budget surplus by 2027. Former Prime Minister Peter O'Neill, however, criticized the Marape government's decision to secure the loan from Australia. He argued that while Australia's support is valuable in promoting good governance, the $570 million Australian dollar loan, approximately $1.4 billion, is merely being used to cover government expenditures from 2024, rather than addressing future financial needs. Main points of the article: 1. New loan from Australia. PNG has secured a $1.4 billion, $570 million Australian dollars, budget support loan from Australia at a 4.2% interest rate. 2. Comparison to past loans. The new loan is seen as an improvement over the 2018 sovereign bond under the O'Neill government, which had an 8.4% interest rate and a single bullet repayment of $2 billion due in 2028. 3. Debt classification issues. PNG's debt is currently rated as high risk due to the 2018 sovereign bond's repayment structure. For IMF involvement, as a condition of the Australian loan, PNG must explore solutions with the IMF to manage the large repayment due in 2028. 5. Economic management and growth. The government claims improved economic management, highlighting non-resource sector growth since 2020 and a 13-year budget repair plan aiming for a budget surplus by 2027. 6. Opposition criticism. Former Prime Minister Peter O'Neill argues that the new loan only covers past government spending rather than future financial sustainability. Deep analysis. 1. Debt management and loan terms. The Australian loan offers a significantly lower interest rate than past commercial loans, making it a better financial decision in the short term. However, its effectiveness depends on how the borrowed funds are utilized. If the loan is used for economic development and debt restructuring, it could be beneficial. If it merely covers existing expenses, as O'Neill suggests, it may not improve PNG's financial stability. The 2018 sovereign bonds repayment terms highlight poor financial planning from the past, as a single bullet repayment creates immense fiscal pressure. The requirement to work with the IMF suggests that PNG might need external intervention to avoid default when the bond matures in 2028. 2. Economic growth and fiscal strategy. The government claims that non-resource sector growth has been strong since 2020, but the article acknowledges that many citizens are still worse off compared to 2012. This indicates that economic improvements have not yet translated into widespread benefits. The 13-year budget repair plan and goal of a budget surplus by 2027 suggest long-term financial planning, but given PNG's history of economic instability, these targets may be difficult to achieve without significant structural reforms. 3. Political and governance considerations. O'Neill's criticism raises a key question: is PNG taking loans to invest in long-term development, or just to cover past spending? If the latter is true, then the cycle of borrowing and debt accumulation will continue, potentially leading to more financial instability. Additionally, the reliance on foreign loans raises concerns about PNG's economic sovereignty. While Australian financial support provides relief, it also comes with conditions, such as working with the IMF, which may limit PNG's policy flexibility in the future. 4. The future risks and considerations. Debt sustainability. The biggest risk remains the 2028 repayment of the 2018 sovereign bond. If PNG fails to restructure this debt in time, it could face a financial crisis, dependence on external loans. If the government continues borrowing without improving revenue generation, future debt burdens could increase, making PNG more reliant on foreign assistance. Political stability. Economic policies are often disrupted by political changes in PNG. If there is a shift in leadership before 2027, the budget repair plan could be altered or abandoned. Conclusion: while the Australian loan provides short-term financial relief and better repayment terms, it does not fully address PNG's long-term debt challenges. The real issue remains the 2018 sovereign bonds lump sum repayment in 2028, which could strain PNG's finances unless effectively managed through IMF-led solutions. The government's claims of improved economic management are promising but have not yet significantly improved living conditions for ordinary citizens. Achieving a budget surplus by 2027 will require strict financial discipline, increased revenue generation, and reduced dependence on foreign loans. O'Neill's criticism is valid in questioning whether the loan is being used for sustainable economic growth or just to cover past spending. PNG's future economic stability depends on how well the government manages its existing debt while ensuring new loans contribute to long-term development rather than short-term relief.